And I've been invited to chair today's meeting. And let me begin by welcoming each and every one of you to this special edition of the Institute's semi-annual Economic Outlook Panel. You are going to hear from three of the Institute's outstanding economists who have said they're going to do double duty for us. First, they will give us their outlook for the major areas of the world economy, covering the up and downside risks facing us. And as is usual in this series, we will move on and we will cover, because of the timing, the elections Tuesday, the presidential and congressional elections. We will hear from them about the macro policy issues that the president and his team will face in this second term. And I'm absolutely delighted that my role today gives me the opportunity both to introduce the Peterson Institute's newest senior fellow and to welcome home our new CEO. We will begin with the U.S. Outlook, presented by Dr. David Stockton, who has just joined the Institute and will be in resident as a senior fellow here starting in January. He is also a senior advisor of Macroeconomic Advisors. David, until recently, served as director of the Division of Research and Statistics at the Board of Governors of the Federal Reserve System. And during his decade of service as the Federal Reserve Board's chief economist, David oversaw the preparation of the macroeconomic and financial market analysis and forecasts for the Board of Governors and for the Federal Open Market Committee. We are thrilled that David would join the Institute, and his outlook on the U.S. economy will be a semi-annual feature of these economic outlook panels as we go forward. And second, we will hear from Dr. Adam Posen, who will discuss the outlook in the euro area and its implications for the U.S. economy and American economic diplomacy. As most of you know, Adam will be succeeding Fred Bergston as the Peterson Institute president as of January 2nd. Adam is returning to the Institute after service of 3 years as a member of the Monetary Policy Committee of the Bank of England, where he earned global recognition as an influential advocate of central bank activism in the context of the financial crisis. He's in his third term as a member of the panel of economic advisors to the Congressional Budget Office and is co-founder and advisor to the INET Council on the Eurozone crisis. And today is his first public appearance since leaving the Monetary Policy Committee on August 31, and I am delighted to welcome Adam back to this hall and to look forward to his repeated appearances at this podium and on that platform in the coming years. And I will note at this point that Adam remains in a press blackout because of his Monetary Policy Committee's work with respect to the UK economy and the Bank of England until December 1. However, David who has just authored a just published report to the Bank of England's forecasting capacity, will be happy to respond to any of your questions on those issues, just as Adam will be pleased to comment on the U.S. outlook. And our third speaker is Dr. Nicholas Lardy, the Anthony M. Solomon Senior Fellow here at the Peterson Institute, who will give us his outlook for the Chinese economy and for the economic implications of the Chinese leadership transition that is ongoing in Beijing as we speak. He will also talk about the challenges he sees both issues presenting to our U.S. leadership. Nick is universally regarded as the world's leading scholar on the Chinese economy. He is a prolific writer of outstanding books and articles. His most recent book, published just this year, Sustaining China's Economic Growth After the Global Financial Crisis, not surprisingly, was a recipient of very high acclaim. Nick joined the Institute in 2003 from the Brookings Institution, where he was a senior fellow of the Foreign Policy Studies program. Before Brookings, he served as director of the Henry M. Jackson School of International Studies at Washington University, and before that, he taught at Yale. And Nick's Outlook presentation on China is a regular feature of the Institute's semi-annual Global Outlook. Each speaker will speak from this podium because we have charts that will be on the board. Following their speeches, they will go to the panel up in front of the board, and each speaker will speak for roughly 12 minutes to present his views. Not enough to get all their wisdom, but you will have a chance during the lively exchange that I anticipate following their remarks. David, Adam, and Nick are prepared to address during the discussion period the full range of fiscal, monetary, and currency issues confronting President Obama in his second term and the 113th Congress that will convene January 3rd, 2013. And we will continue our discussion until the clock strikes 2, at which time the program will end. David, will you begin?
Thank you. It's a great pleasure to be here today and to be joining the Peterson Institute. I'm really excited about having both access to the resident and visiting fellows here, which is very exciting for me, as well as the opportunity to interact on a regular basis with all of you. I'm really looking forward to that. I'll leave it to you folks to determine whether or not having been the chief forecaster at the Federal Reserve is a qualification or a confession, but we'll have to wait and see about that. So let me start with the outlook for the U.S. economy. And let me start with what I think is the most distasteful part of economic forecasting, and that's actually having to write down numbers. Here's both the point forecast and some confidence intervals around my outlook for the U.S. economy over the next 2 years. It's really a picture of ongoing, grindingly slow improvement in the U.S. economy. The pickup you see between 2012 and 2013 is exaggerated by the fact that this summer's drought is probably holding down growth this year by around 1/4 percentage point, boosting growth by that amount next year, assuming that we get some recovery in overall output. So you're looking at another 2% year for activity in 2013. And that means a labor market that continues to sustain increases in employment of 100 to 150,000, probably a small downdrift in the unemployment rate. And on the inflation side, I really don't see anything in the cards to suggest that we're facing any imminent inflation difficulties. If anything, I think it's likely that inflation is going to continue to run a bit below the Federal Reserve's 2% overall objective. You know, underlying this forecast is some improvement in underlying private demands, especially on the household side. But there's still some very significant headwinds that the U.S. economy is facing. And one of the most important of those is fiscal policy. Now, underlying this forecast, I've assumed that we don't go over the fiscal cliff and that we reach some sort of short-term resolution that prevents that. But this forecast does not anticipate a resolution of all the fiscal difficulties and decisions that will put us on a clearly sustainable path moving into the future. Having said that, even if we don't go over the fiscal cliff, there's still a significant amount of fiscal restraint already baked into the cake. Some of that's coming from the continued drag from from reduced government consumption and investment. That's probably worth about a 0.5 percentage point of overall fiscal drag. I think it's quite likely, no matter what, that we'll lose the payroll tax holiday and that the emergency unemployment benefits will expire as is currently scheduled at the end of the year. Another 0.5 percentage point. All these fiscal forecasts at this point ought to be written in pencil, not in pen. And as a placeholder, I put in $50 billion worth of income tax increases. That would roughly match the amount that would be forthcoming if, in fact, the marginal tax rates on upper income individuals do expire. That may not be the mechanism by which those tax increases are delivered to the rich. There could be other ways in which that could be done. But all in, I think we're looking at a fiscal restraint that's equal to roughly 1.5 percentage points of GDP. So while we're getting that ongoing fiscal restraint, I think we're still going to have the Fed doing as it has told us that it's going to do, which is to continue its open-ended program of quantitative easing, its large-scale asset purchases, in an amount that will ultimately accumulate to roughly $900 billion, maybe $80 billion a month starting in January. They've said they're going to continue this open-ended program until they see clear signs of improvement in the labor market. And on my forecast, that isn't likely to happen until the end of 2013 or thereabouts, and even that may be a bit optimistic. I fully suspect that they're going to continue to, their extended guidance is going to be maintained going forward. So I think while we're going to have a lot of fiscal restraint, we're going to continue to get some support for monetary policy. You know, on the private demand side, I think we are seeing some signs of improvement. I think especially in the household sector, if you look at household loan delinquency rates, they've come down very dramatically. Debt service burdens that are currently being faced by households have returned back to levels not seen since the early 1990s. To be sure, I think those aggregates are probably obscuring some significant amount of pain that is still ongoing at the below the aggregates, but I think it's a situation where we're actually seeing some serious improvement. The single most encouraging development to my mind for the domestic economy over the past year has been the turnaround in house prices. The turnaround in house prices, I think, if I had one lever I could have pulled to improve the economic outlook, it would have been house prices. And the fact that we're now seeing that, I think, is encouraging on a number of dimensions. One is obviously some shift from either flat or declining house prices to increased house prices provides an impetus to house purchase by lowering the user cost of capital in housing. I think the idea that housing might actually begin to again look like a potentially good buy is a good story. Two, it's adding directly to wealth on the household's balance sheets, and I think that is likely to be supporting consumer spending more broadly. Three, I think at least some fraction of home mortgages that have been underwater are likely to not be underwater going forward if we get some continuation of house price increases, and that will provide the opportunity for some households that have been unable to refinance their mortgages to do so. So I think that is yet another increase. And then finally, I think in general, improvements in the overall performance of home mortgages is likely to provide a boost to the balance sheets of many financial institutions and provide some impetus again to lending in that score. We're already seeing, as you can see on the right-hand side of this exhibit, some signs, that even on the construction side, where things really have been moribund, that there is some turnaround, some upturn. We're still way below any sort of notion of what a replacement rate might be on overall housing demand, but it's moving in the right direction. So I think the household sector has actually been looking encouraging. It's the business sector most recently that has, I think, provided more caution flags. And I think, and that's despite the fact that interest rates are exceedingly low, so user cost of capital for businesses is quite favorable, and they're sitting on a huge pile of cash. but I think it's a real sign that there is still continuing concern about the uncertainties facing the many U.S. businesses. Some of those concerns and some of those uncertainties are obviously arising from concerns about developments abroad, and Adam and Nick are going to be touching on some of those shortly. But I think some of them reflect very much homegrown concerns, and the biggest one of those, I think, concerns fiscal policy and the fiscal cliff. I think there probably were a lot of political scientists that woke up on Wednesday morning and said, thank God for at least for another 3 years, I won't have to hear the words swing state anymore. For us economists, we're looking forward to the day when we wake up, we don't have to hear the words fiscal cliff anymore. I don't think that's is imminent, but we're all pretty much familiar with the basic elements of the fiscal cliff. It's the expiration of the Bush tax cuts and a variety of other tax cuts, the end of the indexation of the alternative minimum tax, end of the payroll tax holiday, the expiration of extended unemployment insurance benefits, and of course sequestration that is due to take a very significant chunk out of federal spending. So how should we be thinking about the fiscal cliff? So I think it's really a story of two possible cliffs, bad cliff and good cliff, or maybe one could say dangerous cliff and benign cliff. Let me start with the bad cliff. As you can see from this exhibit, if the full effects of the fiscal cliff go into place, this is a huge amount of restraint on domestic demand. I think the CBO's analysis last spring that got a lot of attention, suggested that in fact, if we, instead of just doing what we've been doing, we go over the fiscal cliff, that would take 1.5 percentage points, all else equal, off of GDP growth, push the economy into a mild recession in the first half of next year, and then some improvement later on. That report also showed that there were dramatically different longer-run fiscal implications of either continuing to do what we have been doing, which would result in a continued rise in debt-to-GDP ratios, and going over the fiscal cliff and in essence paying the price of a mild recession to put the fiscal situation on a much more favorable long-term path. And I think that led some folks to think, maybe that's a price worth paying. A mild recession, long-term fiscal rectitude. In fact, I think that's probably not the right way to think about it. And I think the reason is that going over the fiscal cliff is going to be much more costly than even the CBO's analysis suggested. In general, if you think about the fiscal multipliers, at least as broadly construed, I think they're a lot larger now than is generally recognized, and it was probably incorporated in the CBO's work, which was a very sensible and reasonable piece of work. There's no doubt that being at the zero lower bound on interest rates means that there's no capacity for monetary policy to offset any of the additional restraint that we brought on by going over the fiscal cliff. And I think Ben Bernanke made that pretty clear in his press conference, his most recent press conference. So there isn't going to be any cushioning there. The multiplier itself is probably state dependent, meaning that when the economy is weak, the effects of depressing fiscal policy are likely larger. Households and small businesses, we have probably many more liquidity constrained households and small businesses at present than would normally be the case. And there's just going to be no capacity for them to smooth through the effects of the fiscal cliff. And then, of course, the financial system itself still has not been fully repaired. And I think the feedback from a significant weakening of the overall economy onto the financial system and through the financial system to real activity is likely to be much larger. And then, of course, there would be significant negative consequences for confidence as well. So instead of the 1.6 that the CBOs assumed, I think going over the fiscal cliff, I've written something down between 2.5 and 3 percentage points, all else equal, off of growth. In a world, I think the most important aspect of this is an unemployment rate that's starting out at close to 8% now has got another percentage point rise. That is a very, very different world. One, in fact, that looks pretty darn frightening. And I think it would be much more difficult to dig out from that. Again, I think the persistence of that decline, shortfall in aggregate demand is likely to be larger than most people think. And we've already had half of a lost decade. I think going over the fiscal cliff in this manner would be sure to bake in at least a lost decade and probably then some. So I actually don't see much benefit in going over the fiscal cliff. So what about good fiscal cliff? So one argument for going over the fiscal cliff is that it immediately resets the terms of the policy debate by having tax rates move back to their pre-Bush era levels. The debate then will be about how much to cut taxes and whose taxes to cut. And that is a very different discussion than the one that we're currently having. As well, on the spending side, I think sequestration, the looming sequestration would force a debate about how to have more rational cuts in overall spending. That might include the entitlement would almost certainly include entitlement programs as well. If that were all to happen, if you could know for sure that was going to happen and happen quickly, and sound decisions would be made, and we'd be put on a better long-term path, then maybe that would be a price worth paying. I do think if we, even in this scenario, the good cliff scenario, we would be looking at a weakening in overall activity relative to current expectations in the first half of next year, because there's just bound to be lots of confusion and uncertainty raised by that. But that's the problem, even in the good cliff scenario, is if we jump off the fiscal cliff, we're not going to know whether we're going to end up with good fiscal cliff or bad fiscal cliff. So it's one heck of a big risk to take. I can understand the attraction of that. It's quite clear that we'd all be better, I think we'd all be better off if we avoided the fiscal cliff and took decisions to put ourselves on a long-term path. Certainly, this may be naive, but listening to some of the comments since the election in the last few days gives one some encouragement that doors may be open to reaching some kind of a grand bargain that avoids the fiscal cliff, that takes some decisions, some difficult decisions to put the fiscal situation on a better, firmer, more sustainable path going forward. Those are going to be really hard discussions, and there are many difficult decisions to be taken. But if we were to get that, I actually think there's upside risk to this baseline outlook that I've laid out. I do think significant removal of uncertainty, some sense that in fact the fiscal path for the U.S. economy is more sustainable, could lift uncertainties and provide an even greater impetus to overall economic activity. We really need that. I mean, there's been a lot of this economy has been through an enormously painful period, and I think there's a question about, what sort of long-term damage has been done to the U.S. economy by this long period of weak activity. So I think there has been long-term damage. I think we're looking for it in the wrong places, and so let me just explain. Two areas that one often hears people being concerned about are labor market participation and the unemployment rate. Here's an estimate, my estimate, using some research done by the labor economists at the Chicago Fed on the trend in labor force participation. We've had a decline in labor force participation that I think exceeds any reasonable estimate of a decline in trend. To be sure, I think the recession itself may have accelerated the departure of some folks that were already going to be leaving the labor force. No doubt some people have moved on to disability roles as a result of the recession, but Most of this decline, I believe, is cyclical, and I think there is going to be a significant capacity for people to re-enter the labor force once demand, in fact, begins to materialize. The other place is the unemployment rate. You hear lots of concern about, in essence, will we experience the kind of hysteresis in the unemployment rate? That is a permanent effect, that the short-run cyclical increase in the unemployment rate morphs into longer-term structural unemployment. In fact, I think the research evidence on structural unemployment does not point to a significant increase in structural unemployment in the U.S. There's been some evidence that as the unemployment rates fallen, vacancies have increased even more rapidly, what economists would call an outward shift in the beverage curve. But I think that's a pretty typical cyclical pattern because businesses can find it easy and less costly to adjust their vacancies and then alter their recruiting intensity. They can post a vacancy, but they can alter their recruiting intensity. So I don't see that as a sign of significant structural problems. Same thing on sectoral mismatch. I don't think there's some evidence of, but the kind of concerns that people had early on that we were going to find, given that this shock started in construction and finance, that was going to lead to a significant sort of increase in structural unemployment of those workers, I don't think is in evidence either. And house lock, I think if there was a concern that maybe house mortgage homeowners would not be able to geographically move because they'd be locked into a house with a mortgage that was underwater. But research by Rob Valletta at the San Francisco Fed and other researchers as well have shown that, in fact, unemployment durations for owners and unemployment durations for renters in areas where house prices have gone down significantly are just about the same. So I don't think this is likely to be the area, and I think we ought to be able to, as you can see, my estimate had some increase early on in the recession. Part of that was the effect of unemployment insurance benefits, which I think probably did temporarily boost the NAIRU. I think there has been some evidence of a decline in employer and employee matching, but I think that is most likely to fade away as the economy slowly begins to improve. But the pain that we are likely to see persist from the Great Recession in terms of labor market is going to be on the earnings profiles of those people that have been hit by the recession and its subsequent slow improvement and the ongoing long periods of long-term unemployment. Those people are likely to be disadvantaged both now and for a very long time in their overall earnings profiles. Young people just coming out of school or people that lost their jobs mid-career are going to I think, need to adjust down their reservation wages, and that's going to happen. And one of the differences between the United States and certainly Europe is our safety net is a whole lot thinner. I think it is the case that people, in fact, do in the United States adjust down their sort of earnings expectations, their reservation wages over time. So I think what we're going to have is an unemployment rate that will go back to 5 or 6%, but with a lot of people who've suffered very long-term income consequences as a result of the recession. One final note on how the recession has probably affected the U.S. economy is that there's no doubt that the weakness in business spending has shown through, well, we've seen some rebound in the growth of the business capital stock. It's still pretty meager. And after a sharp increase in productivity during the recession, productivity growth has moved back quite substantially. I think we're probably looking at an economy that could only grow, let's say 2% at least for the next half a decade, with maybe 1.5 percentage points of that coming from productivity and 0.5 percentage point from labor force growth. So I think if we're the most serious thing that we can do to support the supply side of the U.S. economy is to make sure we're fostering sufficient aggregate demand, which I think will in fact bolster capital accumulation, it will improve labor market outcomes. I think that is still the most, if we're looking for the most surefire way of improving the longer run prospects of the economy, is to attend to the short run prospects. I'll stop there.